Hi, it's Helen Tarrant. Welcome to another episode of Commercial Property Roadshow with Helen Tarrant. I am here with Shukari and Amir, and we are going to be talking about structures, the very interesting and important subject about structures, mostly because I get asked the question, what happens when we buy a commercial property and there's positive cash flow? So a lot of investors going from residential to commercial are shying away from buying a commercial property because of positive cash flow. Because all of a sudden they think they have to pay more tax, they feel like there's added levels of complexity in there. So to demystify some of those elements, I have come here to speak to Shukri and Amir from Property Tax Specialists, and they specialise in property tax, as the name suggests. So welcome, guys.
Thank you very much, Helen.
So to start out, basically, the number one most important question is, why do they need a structure? Why can't they just buy everything in their own name?
Well, that was used to be the old ways. You just put it in your own name, and then when you do that, of course, all the risk is yours. So if anything goes wrong, then your house is left out at risk. The other thing is there a better way to do it? What are we trying to do? You've got to look at some of the considerations of what you're trying to achieve. We're looking at positive cash flow. If it's all positive, it's going to be taxed in your name. Does your family group have the opportunity to split income? That may be a tax saving device. The other considerations, of course, is land tax. Particularly each state has different land rates, and so depending on the ground, in some cases, with our clients, we found that it doesn't matter that the trust, for example, owns land, because the component of the tax is very small compared to the rent. So, and that allows flexibility. So if you have flexibility, you can split the income between family group, they're over 18, and you can save tax. Also, it may allow you to distribute to other entities that you have, which may be carrying some losses.
Okay, so just to, I guess, give a scenario of what not to generalize, but to just talk about a general scenario of the mum and dad, and let's say mum and dad, 2 kids, they've got a family home, maybe a couple of residential investments. They're thinking of buying a commercial property. One parent is on a higher income than the other one. They're both working, kids go to a school age, and they own obviously a family home. Now they were buying a commercial property, and let's say the positive cash flow out of there is $20,000 a year. Now, how does that work in terms of if they were just going to go out and go, okay, well, if we normally buy residential, we buy it in our joint names, so mum and dad are both on there. Yeah. Now they're thinking, well, if they buy a commercial, do they go and buy it in their joint names? Or you talked about structures and about flowing that through and distributing. Just explain in a little bit of plain terms how they will treat that $20,000.
Okay. Look, first of all, what we'll do is we'll find out issues about risk. Yeah. So that's more important on the capital side. Yeah. So once we've agreed who's risk and who's exposed, then we will go down and try and plan for tax. Yeah. To minimise tax, that's really what it's all about. So if you hold the property jointly, then the $20,000 is split between 2 people, yeah. and the half that goes to the partner with very little income, then there's no tax, there's a saving there. But the half that goes to the partner with high income, it'll be taxed at a very high rate. And then if you sell the property sometime in the future in a capital gains position, there's also going to be a high rate for the person with the tax. So we start to look at alternatives. What are the alternatives available to try and split the income somehow, or create flexibility so that when it comes to sell, in terms of timing, in terms of the value, we can utilise the marginal tax rates of each of the people involved.
That's a very important thing, the asset as well, in addition to the tax implications, the asset protection aspect of it is also key, because you only focus on that usually people at the very end. But if the asset is in their individual names, there's a lot higher risk.
Right. So I guess one of the things that people don't think about is asset protection. Why do they need asset protection?
Well, what you've got with asset protection is the risk for a tenant who's done the wrong thing and there is damage, or if maintenance is not kept up to date, somebody slips over the sort of colloquial banana on the floor, and Coles or Woolies are going to be sued, and the guy is rich forever. And then if you're a small operator, well, there goes your whole asset.
I think because there is a lot of differences in, I guess, when people buy a residential compared to a commercial, and I guess that flexibility is really important, and about sort of asset protection as well. But what are some of the structures they can invest through?
Well, look, we're starting out when we're looking at the investments. You've got the individuals, you can sue and be sued in your own name. You've got the partnerships, you're splitting income already and splitting the risk. Partnership is a problem because if one of the partners gets in trouble, it really impacts all the assets of the other partner as well. You've got companies. Companies are great for carrying on business because their liability is limited to the number of shares on issue. If that's only 2, then that's the risk, as long as you don't give personal guarantees. But then you've got the final thing is going to be companies are useless because you can't get the discount on capital gain. Effectively, you won't get it. So that leaves you with a trust or a super fund, which is a form of a trust. Now the trust has flexibility, it gives you asset protection, it allows you the flexibility to distribute to whoever is in the lower tax bracket, and it allows it every year. All right. It also allows it, if both of you are on very high incomes and you don't need the cash, it allows distribution to what is called a company, which is at a much lower rate at 30%, so that defers the tax for another period. And then you've got the super funds. Okay, again, the regulators are a bit hard, but I don't think that they were talking more about negatively geared residential properties, but positively geared commercial properties are ideal for a super fund, right? And the key is at 15% tax on normal income. That's pretty good compared to your personal tax up to 45 plus 2%, 47. And then in long term, when you do sell it and you're in pension phase after age 60 and so forth, no capital gains.
Wow, so there's a lot of different benefits, a lot of things for them to consider.
Totally.
So when is the right time for them to actually set up this entity or have this conversation with you in their purchasing journey? So if they've just gone and started looking into a property, so they thought, okay, well, commercial might be my next step. So where do they have that conversation with you in
The best thing is the very start, before they sign on the dotted line.
before they sign a contract?
Because when they do that, it's too late.
Yes.
So usually what we do is we assess the whole situation, like Shukri mentioned, the risk profiles, the income, the family unit, and based on that we see what's the best structure for them. Also, if it's positively geared, usually commercial property is. So based on all of that, we assess and we advise before they sign on the dotted line.
And time frame wise, in terms of how long would it take? Say you do the assessment, you talk to them, then you work out what they need, and then how long does it take for them to have that in the peripheral vision of how long things take in the process?
Officially, it's up to 28 business days.
Yeah.
But that's if there is a problem. Usually it takes about a week from where we start the process till the end, if everything goes smoothly.
Okay. Right. So if someone was starting out in this journey and they're looking at some accounting advice of how they can, I guess, effectively manage their affairs, or in terms of asset protection, as well as, I guess, tax minimization and in the family structure as well, what are some of the tips you could give them? The top 3 tips or the advice you keep repeating to clients so they don't listen?
Keep good records.
Yes, well, all of us wish that.
Look,
we have a phone, we take a lot of photos, and we just don't take photos of receipts.
Now, look, the starting point is always we start off by inviting people to an initial consult just to get a picture of where they are and to understand what's driving them and what's driving their decisions, and to put the proposal for the new investment within the context of their environment and their goals ultimately. So within that space, we're looking at, as you said, their family structure group and where they want to go, how the positioning of that particular asset that they just looked, so they would have spoken to you first, right? They would have said, yes, look, I want that. So you would have given them an idea. Look, this is a sample. All right, so now we have a sample of the asset. We have a sample of the amount of income that's likely. We review their positions individually, and we say, okay, within the existing structure of your whole investments, how can we do that? And we make some recommendations as to where the risks are, what the opportunities are, and we say, look, for your circumstances, you should consider A, B, C, and D, and then we go from there as they feel comfortable to move forward to the next step.
Right. So, if
it is at that point that the review of all the structures that are available for them will be looked at, and they will choose and discuss with us what would be more suitable for their particular circumstances.
Yeah, I guess, and a lot of the times that our clients, they come on board and they sort of plan out for the next 3 or 5 or even 10 years of what their purchasing goals or the ultimate retirement passive income goals are.
Yes.
So we try to really instill into our clients, but also people who are coming and learning about commercial property, about the team that we build around. So we talk about, really importantly, for them to understand the accounting and the structure side, so that when they're buying from 1 property to 2 to 10 properties in the future, what is the right structure for them overall, so they don't end up 5 properties in and they have records everywhere and they've got mortgages everywhere and everything's not fitting in. So when you do your planning with them, what does a typical session involve? So they get to understand a little bit about how you help them in their...
So basically we start, like Shukri said, with their situation, what they need. And based on that determines the structures, whether it's going to be individual names, SMSF, or a trust. And from there, each one has its own compliance requirements, and we go through what needs to be done. We find that a lot of clients who sign up for the annual program, which we take care of A to Z, basically from the record keeping with bank feeds and all the compliance, it becomes a lot easier for them. Because there is a big difference between residential and commercial, which a lot of people who are not used to commercial, which is the GST. They can claim GST and they have to pay GST. So that has additional compliance, which a residential buyer wouldn't have to do as well.
And long term, as they come to buy the next one, we look at their situation just before they go on to the next one. Because really, by the time they bought the first one, their circumstances have changed. So you have to review the total position again and how you're going to position the next investment, whether it's in the same trust, whether we need a new trust, what's preferable in their particular circumstances. Okay, and as Amir said, where the administration can be streamlined, it makes it easy for them. They just get the results, they know what's happening, they don't have to worry too much about it, but at least the end results will come out in the way they're expecting.
And I think that's really important. It's about the end result, always for the clients. And I think it's very important about that GST, because a lot of our clients who go from residential to commercial don't realise that there is a GST component, and the question's obviously always asking, do I pay GST on it? Should I register for GST? Why do I need to register for GST? So there's a lot around that, and I think what we'll do is we'll do a follow-up episode on the GST component, so that it becomes a little bit clearer. But in the meantime, how does someone reach out to you? How do they find out about you and what to do, and how can they further engage with you?
Yeah, go ahead.
Our website is propertytaxspecialist.com.au.
And we'll provide a link to that as well.
Yep, and our phone number is 1-800-800-TAX. So that's easy. These are the easiest.
We'll provide that as well.
Or our email is the what is it?
Reception at propertytaxspecialist.com.au as well.
Yeah.
And just reach out, give us a call, enter your details on the website. We'll give you a call back, and we'll see how we can help.
Yes. So it's important to have that initial conversation. So is there a charge for them to have the initial conversation with you?
There is a charge, but what we do is that if they give us more work, we actually rebate it back, and it costs them nothing.
All right, fantastic. So, but please, if you are looking for property tax information and you're looking to find out more about how you could really benefit from getting some tax advice around your property and you really intend to be a long-term investor in the property game, then this is something not to be missed. It's actually essential. So I will be putting all the details below, and in the meantime you can always reach out for more information, or if you missed anything you can always go to helentarrant.com, go to the contact us page, fill in information and ask any questions. We can pass your contact details on to Shukra and Amir and they can contact you. So there's multiple ways to reach out to us. And so, but in the meantime, don't forget to subscribe, hit the bell, and I'll see you in the next episode. Bye for now.
Bye-bye.
Bye.